Most business owners look at revenue and profit, but very few truly understand the financial signals hiding inside their numbers. Revenue alone does not protect you from cash flow problems. Profit alone does not guarantee survival. Financial ratios help you see strength, weakness, risk, and opportunity before problems explode. In this video, we are sharing 15 financial ratios every business owner should track. Number 1. Current ratio. The current ratio measures your ability to pay short-term obligations. The formula is current assets divided by current liabilities. Imagine your business has $100,000 in cash, inventory, and receivables combined. Your short-term bills total $70,000. Divide $100,000 by $70,000 and you get about 1.4. That means you have $1.40 available for every $1 you owe soon. A ratio below 1 means potential stress. A healthy range for most businesses is between 1.2 and 2. Number 2. Quick ratio. The quick ratio removes inventory because inventory cannot always be sold quickly. The formula is cash plus accounts receivable divided by current liabilities. Suppose you have $40,000 in cash and $30,000 in receivables. Your short-term liabilities are $80,000. That gives you $70,000 divided by $80,000, which equals 0.87. This means you cannot fully cover short-term obligations without selling inventory. If your quick ratio is above 1, your business has strong short-term financial stability. Number 3. Cash ratio. The cash ratio is even more conservative. It only looks at cash divided by current liabilities. If you have $30,000 in cash and $80,000 in short-term liabilities, your cash ratio is 0.37. That means you can immediately cover only 37% of upcoming obligations. This ratio is useful during economic uncertainty. While it does not need to be extremely high, it tells you how much emergency strength you truly have without relying on customers paying you or inventory selling quickly. Number 4. Gross profit margin. Gross profit margin shows how much money remains after paying direct production costs. The formula is revenue minus cost of goods sold divided by revenue. If your revenue is $500,000 and your cost of goods sold is $300,000, your gross profit is $200,000. Divide $200,000 by $500,000 and you get 40%. That means 40 cents of every sales dollar is available to cover operating expenses and profit. If this margin shrinks, pricing or cost control needs attention. Number 5. Operating profit margin. Operating profit margin measures how efficiently you run your business before interest and taxes. Suppose your revenue is $500,000. After paying production costs and operating expenses like rent and salaries, you have $80,000 left. Divide $80,000 by $500,000 and you get 16%. That means 16 cents from every dollar of revenue becomes operating profit. This ratio reflects management efficiency. If it drops, expenses may be rising too quickly compared to sales growth. Number 6. Net profit margin. Net profit margin shows what is truly left after every expense, including interest and taxes. The formula is net income divided by revenue. Imagine your business earns $500,000 in revenue. After paying all costs, including salaries, rent, loan interest, and taxes, you keep $50,000. Divide $50,000 by $500,000 and you get 10%. That means you keep 10 cents from every dollar you earn. A healthy net margin depends on industry, but consistent improvement shows strong cost control and smart pricing. Number 7. Return on assets. Return on assets measures how efficiently your business uses everything it owns to generate profit. The formula is net income divided by total assets. Suppose your company earns $60,000 in net profit and owns $600,000 in total assets such as equipment, inventory, and property. Divide 60,000 by 600,000 and you get 10%. That means your assets generate 10 cents of profit for every dollar invested in them. A higher return means your assets are working productively rather than sitting idle. Number 8. Return on equity. Return on equity measures how effectively you are growing the owner's investment. The formula is net income divided by owner's equity. If your business earns $80,000 in profit and the owner's equity is $400,000, divide $80,000 by $400,000 and you get 20%. That means the owner earns 20 cents for every dollar invested in the company. Investors and lenders watch this closely because it reflects long-term value creation and capital efficiency. Number 9. Debt-to-equity ratio. The debt-to-equity ratio measures financial leverage and risk. The formula is total debt divided by owner's equity. Suppose your business has $300,000 in loans and $400,000 in equity. Divide $300,000 by $400,000 and you get 0.75. That means you use 75 cents of debt for every dollar of equity. Moderate leverage can boost growth, but too much debt increases vulnerability during downturns or rising interest rates. Number 10. Interest coverage ratio. The interest coverage ratio shows how comfortably your business can pay interest on its loans. The formula is operating income divided by interest expense. If your operating income is $100,000 and your yearly interest payments total $25,000, divide $100,000 by $25,000 and you get 4. This means your business earns 4 times the amount needed to cover interest payments. A ratio below 2 can signal financial stress and possible lender concerns. Number 11. Inventory turnover. Inventory turnover shows how efficiently you sell and replace stock. The formula is cost of goods sold divided by average inventory. Imagine your yearly cost of goods sold is $300,000 and your average inventory during the year is $60,000. Divide $300,000 by $60,000 and you get 5. That means you sell and replace your inventory 5 times per year. A low turnover may signal overstocking or weak demand. A higher turnover usually means better cash flow and efficient inventory management. Number 12. Accounts receivable turnover. This ratio measures how quickly customers pay you. The formula is total credit sales divided by average accounts receivable. Suppose your annual credit sales are $600,000 and your average receivables balance is $100,000. Divide $600,000 by $100,000 and you get 6. That means you collect receivables 6 times per year. Faster collections improve cash flow. If this number falls, customers may be delaying payments, which can quietly create serious cash flow pressure. Number 13. Accounts payable turnover. Accounts payable turnover shows how quickly you pay your suppliers. The formula is cost of goods sold divided by average accounts payable. If your cost of goods sold is $300,000 and your average payables balance is $75,000, divide $300,000 by $75,000 and you get 4. This means you pay suppliers 4 times per year. Paying too quickly may hurt cash flow, while paying too slowly may damage supplier relationships. Balance is important. Number 14. Break-even ratio. The break-even ratio helps you understand the minimum sales needed to cover fixed costs. The formula is fixed costs divided by contribution margin. Imagine your fixed costs are $120,000 per year. Your contribution margin per dollar of sales is 40%. Divide $120,000 by 40% and you learn that you must generate $300,000 in revenue to break even. Anything above that becomes profit. This ratio helps set realistic sales targets and pricing strategies. Number 15. Cash flow coverage ratio. Cash flow coverage measures your ability to repay debt using actual cash flow, not accounting profit. The formula is operating cash flow divided by total debt. Suppose your operating cash flow for the year is $150,000 and your total debt is $300,000. Divide $150,000 by $300,000 and you get 0.5. That means your yearly cash flow covers 50% of your total debt. Lenders value this ratio because cash, not profit, repays loans. These 15 financial ratios give you a complete view of liquidity, profitability, efficiency, and risk. When you track them consistently, you stop guessing and start managing with clarity. Strong businesses are built on numbers that are understood, not ignored. If you found this helpful, make sure to like the video, share it with another business owner, and subscribe for more practical business finance content.